Hello, everyone. Thanks for joining us. We'll start shortly, just a couple more minutes to wait. Good afternoon to everyone who's joined us. I see that we have a number more people who've said they're coming, who've not yet logged on, so we'll give them a minute or two before we get started. Well, hello and welcome to this live webinar, Securitizing Cloud Outage Risks. The cloud, which is nothing more really than other people's computers, has quickly become a huge phenomenon in business. Like electricity and 4G, the cloud has become a utility on which everyone relies. 92.8% of large enterprises surveyed by our hosts for today's webinar, Parametrix, said last year that they're at least somewhat reliant on cloud services. I'm here to talk today about the securitization of cloud downtime risk are some extremely experienced people. We will kick off with a presentation about the state of the cyber and insurance-linked securities markets by an ILS pioneer, Henning Ludolphs. He's managing director for Retrocession and capital markets at Hannover Re. Henning spent more than 30 years in structured reinsurance and ILS and has led Hannover Re's ILS team since its inception. People are speaking a lot today about cyber ILS, and most of it has to do with the activities of Henning and his team. After that, we'll hear from Sharon Haran, Chief Commercial Officer at Parametrix Insurance. He's going to talk about the possibilities for the securitization of cloud risk. Sharon's career spans insurance, new ventures, technology and finance, and success seems to follow him around. His combination of skills is ideal to nurture the birth and evolution of cloud downtime securitization. Finally, we'll learn about the cloud, how it works and where it's going from GlobalDots, a cloud trusted advisor and innovation company that's been in the cloud business since the beginning, more than 20 years. We'll hear from Alick Friedman, Partnerships and Alliances Manager at GlobalDots. Alick has spent his entire career building relationships for IT companies. We couldn't ask for a more informed panel, but before I hand over to them, I'd like to encourage you to ask them some questions. You'll see a Q&A box at the bottom of your screen. Please use that to answer questions of our panelists, and at the end of their presentations, we will get to the questions. So now, without further ado, I will hand over to Henning Ludolphs of Hannover Re. Henning?
Thanks, Adrian, for the introduction, and hello to everyone. I will give Hannover Re's perspective on cyber ILS and cloud outage. Let me start with cyber in general. It has grown tremendously over the recent years, and the growth is expected to go on. Some comments I've read is that people said it may triple over the next 4 to 5 years. I personally think this may be a fair assessment. But we had also adjustment of pricing, a favorable adjustment of pricing over the last 2 years, which makes it interesting. On the other side, cyber risks are probably more difficult to assess. Neither do we have a long history yet, nor do existing models, and we have models, had the chance to be calibrated over and over again, as, for example, the hurricane models in Florida had, because we had lots of hurricanes. So you could say cyber is a higher risk. Is it necessarily bad? No. A higher risk means you have also higher volatility loadings, and you should have a higher expected return when you engage with this. And this means it should be interesting for risk takers. Who are the risk takers? First of all, of course, the insurance companies who provide or issue the policies to the insureds. The insurance companies will not be able to absorb all the risk. They need the reinsurers. The reinsurers in turn will not be able to absorb all the risks. They need the capital markets. Of course, insurance companies could also directly go to the capital markets. So cyber means for the insurance, the reinsurance industry, and capital markets an opportunity to grow and to grow together. I'm convinced that the industry will not be able to provide the cyber capacity required in the long run if not all three, insurers, reinsurers, and capital markets, support. Let me comment a bit on diversification. In natural catastrophes, it's sometimes pretty easy. A hurricane in Florida is not correlated to an earthquake in Chile. This is not that easy to clarify when we come to the cyber world. However, at least for the Hannover Re, most of our contracts exclude natural catastrophes as a cause for cyber events. And of course, on the other side, cyber events do not cause natural catastrophes. From that perspective, cyber should be a welcoming, diversifying asset to portfolios of natural catastrophes. Let me have a look at the investor community. First of all, I appreciate that there are many investors and ILS investors who simply cannot invest into ILS simply because their frame doesn't allow it. There are, however, I know quite a number of investors who have some flexibility or who have quite a lot of flexibility. And it's probably a good timing to get the foot into the door. Maybe not necessarily with large volumes. Start small at the beginning. Grow together with your insurance or reinsurance partner. Yes, learn about the positives and maybe also the negatives. But in the long term, definitely to the mutual benefit of all parties involved. And from the pricing perspective, the timing currently should be good because the price levels have gone up quite a bit. What ways of transfer from insurers to investors we have? This is probably a bit boring now for those of you who are from the reinsurance industry. Nevertheless, let me glance through these various forms. First of all, it could be a proportional reinsurance, a quota share. From an investor's perspective, means simply You get access to a portfolio of risks and you follow the market. However, you do not have an individual risk selection. It's not really short-term and maybe not really transparent. Then you have the non-proportional structure, the excess of loss or aggregate excess of loss structures on an ultimate net loss basis, which means you pay the actual losses happening. From an investor perspective, you have an individual pricing and may select certain direction of risks. You follow the know-how of a reputable underwriter, but there are also negatives. You have a pricing risk. You have to make sure that you have real good event definitions. It's not really short-term again, and it may not be necessarily very transparent. Then you could change to a parametric approach. This now is dislinked from the underlying underwriting. Usually you should have clearly defined perils. It's short-term and transparent. On the con side, you need to have a model where you trust in that the model reasonably approximates the reality. I do not want to say one of these forms of transferring risk to capital markets is better than the other. All have their pros and cons. And I think it's an individual assessment of the situation of every investor to see this makes sense at this stage or this does not make sense. Interestingly, if we look back at the ILS business, which actually started in 1994, and the first ever transaction on the P&C side was done by Hannover, not by myself, but if we look at the first about 10 years of ILS business, and in those days it were almost all catastrophe bonds, the majority were based on indices or parameters. So in fact, the investors closely approached the ILS business by starting with parametric business. It's short term and it's transparent. And to a certain extent, you could do a similar approach now. You start slowly with a small amount and start with an index or a parameter just to get into the business. From the Hannover perspective, we have been active in cyber since 2013, facultative and treaty reinsurance, and underwriting is decentralized, but risk management centralized. I think we are, with 600 to 700 million premium income, a larger provider, and I'm sure we will grow further and we will remain among the largest reinsurance providers of cyber risk protection. In doing so, we want and we need support from our retrocession partners. This could be on a traditional basis, but we are strongly looking at capital markets. We are working with capital markets anyway a lot on life business, on P&C business in various forms. So the capital markets players are basically a natural partner for us. What kind of form are we looking at? At the end, we will look at it proportionally and non-proportionally based on parameters and not non-parametric. And you may have heard recently we've done a larger cyber quota share. Now, a next step, a cyber structure, a cyber excess of loss structure, or cyber cat bond is probably a natural step for us. Cloud outage was having a lot of reinsurance business in cyber. We naturally, obviously, have a lot of cloud outage risk. And as more we grow, the more cloud outage risk we have. And when we look at our internal models, they require us to put capital behind the cloud outage risk. So for us, it makes a lot of sense to look at ways to take a piece of the cloud outage risk and transfer to capital markets. The piece of ideally can be larger, but let's start small in order to become large at a later stage. And a good start is indeed look at it from a parametric perspective. This brings us to the company Parametrix, whom we know from other business. We have an MGA relationship. So we know them, we have worked with them, and we are satisfied with how they work. And we think it's a natural expansion of our work together with Parametrix to structure a cyber transaction, which we are actually doing. And of course, we want to bring this to investors. We want to start now, maybe not too large, but expand over time with our partners. And in the long run, may even we think of transferring risks of our clients to the capital markets, which we do substantially already on the life and on the P&C front. We believe we have here an underlying exposure which is clearly defined and short-tailed, and I think let us get started transferring outage risk to capital markets on a parametric basis. This would conclude my little summary, the Hannover view. Thank you for listening.
Well,
Adrian.
Thank you, Henning. That was fascinating insight, an interesting look at what you're doing in this field. Before we move on to our next speaker, I'd like to encourage our webinar attendees to ask some questions for Henning or the other panelists in the questions box, the Q&A box on the bottom of your screen. Without waiting any further, I'll turn on to our next speaker, Sharon Haran, who's Chief Commercial Officer at Parametrix.
Thank you very much, Adrian. Good afternoon, good morning, everybody, wherever you are. I would like to tell you briefly about Parametrix and our activity in the cloud outage world, or in the more specifically, our solution that we have tailored in order to enable insurers and reinsurers to transfer cloud outage risk to capital markets. But before we start, just a few words about Parametrix. Okay, sorry. So Parametrix is a leading cloud downtime insurance providers. We index, model, detect downtime events based on data-driven solution and real-time global monitoring system. We have two business activities. One is related to our MGA, which is based mainly in the US, which is backed, among other, by Hannover, but also by Kilm, Renry, and some other syndicates. And we have a very robust technology and actuarial side that enable us to build those sophisticated models in order to enable the insurance industry to transfer this cloud outage risk to the capital market. So the risk of a cloud is increasingly growing. More and more companies are moving into the clouds. The trend of buy, spending instead of buy, moving from CapEx to operational expense is getting more and more momentum. And the growth of the cloud is tremendous. I think it's one of the only few industries around the world that, despite of anything that happened today, grew in 2022 in more than 20% on revenue base, despite of the fact that those companies are generating tens of billions of dollars in revenue. And this is a very unique phenomenon. And this phenomenon is getting even more aggressive as we see more traditional companies and not just young startups companies, banks, financial institutions are all moving into the cloud. And as such, the risk is exposing. We like to say that downtime is a matter of when, not if. And almost every single week, we face certain levels of outage events. Some of them, or actually most of them, are relatively short in their period, and they might affect different aspects of the business. So we just recently, and I guess that some of you have experienced that, there was an outage of Microsoft Azure in the morning. It impacted most of the European countries, and everybody which was trying to use Teams, for example, couldn't access the system. Luckily, it happened during the night hours in the US, so not a lot of US companies were affected by this event. But the list of those events is increasing as more and more companies are moving into the cloud. And this risk of cloud outage is becoming a major risk for companies. We just took a look into the financial reports of 2 out of the Fortune 500 companies, And I could assure you that it's always in every tech and related company. And if we looked at Netflix and Expedia, for example, in their financial reports, they said, and I quote Netflix, "We rely upon our Amazon Web Services. Any disruption would impact our operation and our business would adversely impact it." Or if we look on Expedia, we now depend on the availability of AWS services, and so on and so forth. So companies are realizing that their dependency on AWS, their dependency on the cloud in general, and the fact that the cloud outage could severely impact their businesses. And as such, they choose to insure it in a way that in their current cyber insurance policies, they normally would include a business interruption clause that will help those companies to mitigate losses due to cloud outage. And that's became a huge industry concern. And as Henning mentioned before, we see that more and more companies and the industry as a whole starting to identify the cloud as one of the most significant systematic risk for the insurance industry as a whole. Just in order to illustrate for you all the impact of this potential systematic risk, we have just recently conducted an analysis on the all Fortune 500 companies. And as you could see here from the graph on the right-hand side, 75% of the cloud usage of the Fortune 500 companies is concentrated only on 6 cloud regions. And our colleagues from GlobalDots will later on explain you what are regions and how the cloud is being constructed. But 75% is kind of a massive number. And if we take the annual revenue of those Fortune 500 companies, which is $16.1 trillion, and we take it and 24 outage for 2 of the largest regions here on the right-hand side that accumulate around 50% market share of the cloud usage, it could, in a very simplistic calculation, and I'm sure that we need to have much more complicated one, but this is the most naive calculation. You could see that an outage of 1 day could lead to a loss of revenue of more than $22 billion for the Fortune 500 companies. And it's true that not all of the companies are 100% dependent on the cloud. Some will have a higher impact, some will have lower, but on average, even if we cut this number by half or even by 4, we will see a dramatic impact on the industry as a whole from such an event. And even if we look at net profit, the numbers are quite impressive and worrying. It's true that the industry is not taking the whole risk upon itself, but even if we take the limits that are currently incorporated within the cyber insurance policies for Fortune 500 companies that could vary between $50 to $350 million, you could understand that such an event could create an industry loss of hundreds of millions of dollars. And that, of course, doesn't include all the hundreds of thousands of SMBs companies that are also relying on these regions. So I think it's quite clear, and Hannover already captured it quite fast, that cloud outage could lead to a significant loss to the industry. And this is the point where we're getting into the picture while designing our cloud-in-the-box approach. So to be honest, what we are trying to do is to take a lot of things that were incorporated into the traditional, I would call it cat bones model, and bring it into the technological world. And in order to do that, we had to define quite clearly what is the coverage and the scope, what would be the payout formula, and most importantly, what is the outage definition? Because many people speak about cloud outage, but what is exactly cloud outage? Is it the whole cloud? Is it a specific region? It should be a specific service because the cloud is a very monolithic environment. And last but not least is the monitoring and alert, because we had built a very sophisticated monitoring and alert system that could provide both the insurer and the investor a clear transparency into this risk. So how normally a cloud-in-a-box transaction would look like? We would first specify who is the cloud vendors. Are we insuring AWS? Are we insuring Google or Microsoft Azure? All of them Are we ensuring an exposure in a specific geographical environment that would include all three cloud service provider? All of those could be defined in advance based on the exposure of the specific reinsurer and insurer. Then we would select exactly what are the regions that will be affected by such an event. Should it be California? Should it be Japan for Japanese insurer? Or maybe it should be Frankfurt for all the European ones. And then the last level is exactly defining what are the cloud services that we have to insure, because cloud, as I said before, is not a uniform word, and it consists about different services. And each one of those services, its unavailability might have a different impact on the industry. So we will have to select what exactly are the cloud services that we are going to monitor. And last but not least is the financial structure that would include normally what would be the payout structure according to the length of the event, what should be the waiting period. And I will show you now a simple example for how such a transaction could look like. So for example, if we will take a European exposure of AWS, which is normally that consists of two regions, EU West 1 in Ireland, and the region that is based in Frankfurt. For this purpose, we will say that the cloud service would be compute, which is one of the core services that is being provided by all of the vendors. And we could define that the waiting period will be 24 hours, and the coverage duration will be 10 hours, the transaction size will be 60 million, and the payout structure will be per occurrence, of course, and will pay $6 million per every hour. And the implication of that, for example, certain loss example, I will skip now to the second one because we will be able to share this presentation later on, but let's assume that AWS EU Central 1 experienced an outage during an event of 17 hours and 30 minutes. Nothing would happen because it won't trigger the waiting period. But on the other hand, if we go to the last one, if AWS EU West 1 goes down for 27 hours, and thereafter in the separate date, AWS East 1 is going down for 25 hours, there will be just a payout. It's EU East 1 will go down for 1 hour. We will have it all together 4 hours of outage that would trigger $24 million of payout. So what are the key benefits of this approach? First and foremost, objectivity. Claims are only triggered by measure outage of a clearly specified service of cloud vendor. There is a very robust definition. What is an outage? What is the trigger? When the event starts, when the events end, what should be the threshold, which below it, it will be considered as an outage. And I will show you shortly some graphs that illustrate that. We provide an access to the cloud monitoring that provide investors a real-time view, so you don't have to run like in Hurricane, I think, to CNN to see whether the storm is getting on. You just open your computer and get a real-time view about the performance of the specific region or the specific service which is covered under the transaction. Claim adjusting and expenses, as Henning said, it's a short tail, very simple, very fast commutation, and we shouldn't expect any reason why, if there was no event until, let's say, December 31st by midnight, why the process should be ended and an investor could get their investment money back in a very short period of time. And last but not least, I think in this approach, there is no room for moral hazard. There is an inherent risk alignment between the investors and the cloud vendors, which are the best in class. If we look at AWS, Google, Microsoft Azure, all of them are incentivized to manage outage risk in a very efficient and fastly manner. So none of them would be like to expose on their own to such an event, and given the nature of the competitive nature of the cloud environment. So we're sure that each one of them will do their best in order to recover from such an outage event. A few words about the monitoring and the access to the data. So Parametrix built a monitoring system that actually covers more than 250 data centers all around the world. The monitoring system is tracking the availability and the performance of each one of the services that is being provided by AWS, Google, and Microsoft Azure. Just to give you the sense, we are conducting more than 900 million tests every week, and everything is being done in a non-intrusive way and a very objective way. So we are not dependent, or we are not cooperating in any way with the vendor. So our view is external and purely objective. Based on this system and additional effort that we made, we managed to collect historical data for the last 10 years that enable us also to build up the models in order to price this risk. This is just a snapshot of how an outage event could look like through the monitoring system. This is an event that occurred in 2021 in December. It was an outage of AWS. And as you can see here, it's quite easy to see and follow those kinds of events through the monitoring system. And this is another view of the monitoring system that will be provided to investors. And as you could see, when things are normal, everything should be in 100%. But if things start to deteriorate, an investor will have direct access to be able to follow and get all the relevant data in order to calculate the loss. If you want to read more about our solution, you're more than welcome to download our white paper. You could find it on our website, parametricsinsurance.com. Thank you very much.
Well, thank you. Fascinating to learn a little bit about the inside of the cloud and how it works. For the final presentation of today's webinar, I'd like to turn to Alick Friedman from GlobalDots that is actually delivering the cloud to businesses around the world. Before I do so, please add your questions to the chat and we'll get to them, if not live in action, then in a written form, then at the end of the webinar. But now over to you, please, Alick.
Thanks a lot, Adrian. Can you hear me?
We can.
Yes. That's phenomenal. Hi, everybody. My name is Alick Friedman. I'm from GlobalDots. And here is my QR for my LinkedIn and my email. So please feel free to drop me a line after this presentation. Today, I will go over the cloud status. Just a quick word about GlobalDots. GlobalDots has been around for 20 years. So right before a public cloud started, we have almost 140 cloud experts globally. We operate in over 16 branches and having 500 enterprise customers that are using our solutions and almost 100 vendors that we resell or we highlight to our customers. What are our customers? They are enterprise customers globally, notably our Lufthansa, Wizz Air, Ferrari, DBS, which is a Singaporean bank, and Fiat. And what we do, we basically give a 360% coverage of cloud services. We have the knowledge, we have the expertise. We work with all major cloud service providers, CSPs, such as Google, Amazon, Microsoft, and even Alibaba Cloud. Recently, we focused, due to economical turmoils globally, we decided to focus also our abilities on FinOps, or cloud cost optimization, which means how we get a spend of a customer, his cloud bill delivered to us, and using different solutions, we can optimize his bottom line. Today's agenda will be focusing on four main concepts. One is defining the concepts of the cloud. We're going to talk about the shared responsibility model. What does redundancy mean in a global infrastructure cloud environment? And lastly, we'll talk about outage outcomes. Definitions. Does anybody know what is the cloud? You know, it's this term that it's super used and it's being thrown out in the media. A cloud is where you store your files.
Can you share your screen, please?
Yes, I'm sharing my screen. It's not.
No.
Okay, one moment, please. Thank you for stopping me. I thought I'm sharing it. Just a moment. Can you see my screen now?
Yes, perfect. Thank you.
Thank you. Sorry for that. As I mentioned again, Alick Friedman from GlobalDots. This is my QR. This is my email. Feel free to drop me a line afterwards. As I mentioned, GlobalDots operates globally with almost 16 branches, 150 personnel, and 500 global customers. These are some of our customer lists. As I mentioned, Lufthansa, Wizz Air, Ferrari, DBS, and Fiat, all global companies where GlobalDots are helping. What can GlobalDots do? We basically operate and cover your cloud environment. We offer you a 360 cloud environment coverage. And lastly, or recently, as I mentioned, we're focusing on FinOps, which it means cloud cost optimization. GlobalDots get the bill of the company. We analyze it, add our expertise, and create a better or a financial save, a better bottom line for our customers. What we will talk about in today's agenda, again, we'll define the cloud, we'll talk about the shared responsibility model, we'll talk about redundancy, and we'll have the last chapter, which is outages. Definitions. What is the cloud? As we mentioned earlier, the cloud can be the place where you store your data, or we here decide that everybody needs to move or migrate themselves or shift and lift their servers to the cloud, and you can work in the cloud. These are high-level notions. But what is the cloud according to AWS? Cloud computing is the on-demand delivery of IT resources over the internet with pay-as-you-go pricing. Does anybody know what this is? It's a big warehouse. Does anybody know what this line is? It looks like ice cream makers or little refrigerators that are compartmentalized and stored in big halls such as this one. Well, these are data centers. And in data centers, you have you have servers, which are powerful computers that come in rack form, and they can handle compute or different technological requests. These servers are not easy to maintain and operate. They have a full 360 coverage of personnel, operational, security, engineers. You have a lot of resources in air conditioning, temperature, hydration. If any one of these units fall or fail, there might be an issue within the data center. Virtual machines, virtualization. This is the key element that actually allows cloud to be scalable. It's basically allocating virtually pieces of your server and leasing it to other users. This is the ability to transmit from huge servers or huge data centers to regions and then availability zones and serve millions of users. Here are the key 7 elements of cloud. And before I would like to go further, I would like to give you a nice analogy, right? So cloud computing is like renting a car instead of buying one. Instead of having you to pay and maintain for your own car, you just rent it whenever you want it and return it when you're done, right? Easy. Similarly, with cloud computing, you can rent or lease computing resources on an as-you-need basis or pay-as-you-go model without having to own or maintain your own physical infrastructure. Here we can see as I mentioned, the key 7 services, which the most known one is compute or virtual machines. In AWS's lingo, it's called EC2, as we can see here. And these are computers that we can use, or they lease out their compute abilities, enabling the running or the deployment of any sort of online software or cloud usage. Now, on top of EC2, we have almost 300 services only on AWS, which is the most known or most used cloud provider out of the CSPs. The main take from this slide is that the most used ones are compute and storage. Storage, think about like a Google Drive or Dropbox, where S3, as you can see here, and leverages that and integrates in the backend with multiple web applications. So whenever you upload an object, a file, or any sort of block data, it can be allocated rightfully to its resources. Part 2, shift of responsibility. This is a very short chapter, but an important one for this conversation. The shared responsibility module basically sets the tone between the users and the cloud providers. It sets the responsibility of each side. So we can see that on-premise with no cloud provider in the middle, the user or the owner of the operation has to take care of all these elements, anywhere from hiring the security guards to patrol the environment, getting and renting an office space or a big industrial area, connected to the internet, loading the rack or the servers with an operating system and configuring it and basically making it work. So the more, sorry, I'm clicking the slide, and the more responsibilities taken from the user, the more the CSP gets involved. And we can see here in a SaaS AWS deployment, it means that AWS or the cloud service provider is responsible for the majority of the connection, leading only the application or the bare code to be uploaded by the user to the system. Part 3, redundancy. What is redundancy? Redundancy, according to Synopsys, a world-known chip maker, it means that geographical redundancy in cloud computing replicates data between 2 or more different locations. These data centers should be far enough apart so that if one gets hit by a natural disaster, the others will stay safe and support. This is exactly what redundancy means on a global level. We can see here in the AWS regions chart, the different regions. When you hear the word region from a cloud service provider, it means that this is fully independent and isolated geographies that are automatically being replicated and being secured, connected to the AWS backbone, and each region is also supported by multiple availability zones. We have the region, which is the larger geography, and the support by the availability zone. As you can see, Tel Aviv is expected to become a region this year, and there's already 28 active regions serving basically the entire world. In this example, you can see an availability zone that is supporting a region. For example, the North California region is supported by 3 availability zones: US West 1A, 1B, 1C. It means that each one of these letters, 1A, 1B, 1C, it is a full data center, full-blown data center that is 60 miles apart from one another, which means that if one of these data centers, I don't know, gets completely turned off or gets struck by lightning or an earthquake moves it and destroys it to the ground, the other 2 data centers will actually support the availability zone, supporting the region, and there would be less downtime. They are connected with low latency links or cables or fiber optic cables that are securely laid down, and they are fault tolerant. Outages. What is a downtime outage? A cloud outage is a time span during which a cloud provider's services are unavailable to end users. The vendor's infrastructure goes down due to a bug, power failure, just as Sharon explained earlier, and the clients lose access to cloud-based assets until the provider fixes the issue. Here, I just brought some stats that according to Gartner, almost all of the companies did experience some sort of an outage, and outages, as you can see, are very pricey by minute, by hour, by day. Again, the majority of the companies experienced outages on their digital assets. Here, I think we are a little bit limited on time, so I'll jump that example. The day that the internet broke, it was June 21st, 2022, and basically Amazon, eBay, Reddit, Twitch, Spotify, Hulu, PayPal, all these companies became down, had experienced an outage due to one of their providers' lack of ability to support them. So they actually went down for over an hour. High availability, how do you create high availability? Well, you use different capabilities that the CSPs enable or allow for multiple replication of data. So for each and every sort of feature or technological expansion of the company, the developers in the backend actually multiply them and can place the different code or the different additions on multiple availability zones and multiple regions, enabling a full sort of a safe, a proof-safe environment. AWS provides SLAs for outages. You can see on compute, on database, on storage, they have unique SLAs. And for example, AWS makes 2 SLA commitments for Amazon EC2. One, there's a regional level SLA that governs Amazon EC2 deployed across multiple availability zones or regions, and a different one, which is an instance level or a computer level SLA that governs Amazon EC2s individually. This means that if solutions the SLA, the technology infrastructure is not backed in multiple regions and availability zones that are more pricey to the end customer, Amazon will provide less SLA to the end user. Needless to say that they only cover what spend needs to be spent to AWS and not the entire business outcome or the entire business pain that the end customer can experience. So this would be my end of presentation. I kept it, I know, 2 minutes after my time, but the floor is yours.
Well, thank you, Alick, for those insights. We have some time for questions now. We had a few questions come in already, but our team of panelists has been on the fly answering them in real time. So I encourage you to look at the answered questions section for some of those. But there are others we haven't yet answered. And here's one, not aimed particularly at any individuals on the panel, but I'm sure a few of you could have a go at the answer. This is a question from Richard. It says, given possible reluctance of cloud providers to offer transparency of their security/resilience precautions, perhaps he says due to liability and their own security concerns, are reinsurers/investors able to become sufficiently comfortable in underwriting and surveillance of the risk? Maybe I'll put that question first to Henning and then to Sharon.
I'm not sitting at the front to do the underwriting, but I know that we have a lot of cloud outage risk probably part of larger packages we get in. So I think, yes, Hannover Re is prepared to take such risks within a certain frame of conditions. I will not be able to comment now precisely how to look at this because I'm not the front ILS, front cyber underwriter.
Fair enough. Sharon, maybe you can shed some insight into how to make insurers and investors sufficiently comfortable in underwriting or surveillance of the risk.
I think that's exactly the uncertainty that Parametrix is trying to solve. Parametrix monitoring system, as I mentioned before, is independent from the cloud service providers. So we are getting a real-time view for the last 3 years, managed to collect a very, very granular data about the performance of each one of the services in each one of the data centers. And also it enables us also to, I would say, look into historical data, better understand the historical data. So today, actually, we don't need anything from the vendor themselves, but to use their services and see how they perform. So I think this uncertainty was exactly filled up by Parametrix monitoring system and Parametrix modeling. And through our MGA, at least for the last 2 years, we see that the way we price this risk based on our data make a lot of sense, both to customers and to the insurance industry.
Thanks for that. That's clear. I have a question for Alick here. I still think of the cloud and of data centers as something relatively new. Perhaps that's because I'm relatively old. But it must be the case that many data centers have now been around for rather a long time. Is this infrastructure beginning to deteriorate? Is there a differentiation? Can you compare to find differences between some cloud service providers and others, or some data centers and others based on their age? Is it a factor?
Great question, Adrian. So data centers have been around since ever, right? You have the compute capabilities, you have storage, you have all these types of uses of servers. And we can see, for example, in the Far East, in APAC, customers that are just now hearing about the cloud, they did really well without any need to migrate. But as time flies and we see global solutions being printed out from small startups, from small moms and pops garage startups that can hit globally, you need the content, you need global resources to support any business claim today. And sticking to a regional data center or multiple regional data centers has a high operational expense, as Sharon mentioned before. And I don't see the cloud going anywhere. I don't see a physical server, a data center, physical server rooms being also deleted out of this globe. But we are seeing a slow and steady migration to cloud data centers.
And is the physical infrastructure equivalent across the data centers? And maybe this is a wider question. Are we now beginning to see a difference in the performance of individual CSPs based on their infrastructure, or perhaps based on their hardware in general, notwithstanding its age? Is there a difference between the big three, who have about 2/3 of the market, and all of the rest of them, some small and large? Are some more reliable than others?
I think that what we see, at least from a Parametrix approach, is that, of course, not all of cloud service providers has providing the same level of performance. And even within regions, within a specific cloud service providers, not necessarily the stability is the same. And it's true that the hardware is improving over time, but if you look on the root cause of most of the events, you would see that human error is the #1 cause for most of the outage event. As long as people today is the Women Day. So as long as women will be involved in the programming, deployment of new codes, I guess that problems will continue to remain, whether it's men or women, it doesn't really matter, but I think that's a key factor that we have to take into consideration. So cloud outage will stay there, and we have to think how we protect ourselves against it.
Absolutely. I just want to support Sharon's claim, and I'll just put the GlobalDots hat on for 20 seconds, is that we are multi-vendor by choice. So we operate with all the large CSPs and tailor-made the solution, or come to the end user or our customers with the best sort of status for what his needs are. Needless to say, as Sharon mentioned, all the CSPs do provide high performance. Some of them started more late in different geographies, so it enabled sort of a fluctuation in the market. But most of the cloud service providers are very steady and safe, but they're not foolproof safe. So this is why we need to use solutions such as Parametrix.
Okay, thank you. We just as Sharon was answering the question, an attendee asked, can we talk more about the causes of downtime? Specifically asked, is ransomware a cause or a human error more of a problem, or is it software vulnerability? Sharon, can you give us an idea of the balance of causes and possibly address the risk management and mitigation possibilities that come before transfer?
Yes, so I think it's important to say also for investors, and Henning mentioned that before, and that until today, there was no outage event that was associated with cyber event. So there was no cyber attack that caused one of the free cloud service providers to go down. So that's one very important aspect. So it's quite two distinct risks. And historically, I think that there was also just one case that the data center went down because of a lightning storm, and that was for less than 15 minutes. So we hardly see correlation with either cyber or netcat. And as I mentioned before, the number one is human error. Thereafter, it's electricity failure. In many cases, it's also networking failure. But as Alick mentioned, the infrastructure of each one of the data center is structured in such a way that there is a redundancy between the different elements. So each data center would normally be connected to two separate electricity power. It will have generator that will sufficient in case of a power outage. So the system is built in a very robust way to enable those data centers to recover failure at certain point of time.
Thank you, Sharon. I've got a final question that I'd like to put to Henning, and I'd like to ask for not something as concrete as some of the answers to the questions we've had some more, but perhaps you could tell me how you feel about the viability of cloud downtime risk as a type of risk, as a class that will appeal to the capital markets and to ILS investors relative to other sorts of risk. Well, we've seen lots of interest in natural catastrophe risk over the last couple of decades since St. Paul Re, and not much action anywhere else. Is this the breakthrough? Is this the one that will crack open non-nat cat risk?
I see all risks which have a short tail nature, principally suitable to the investor community. And I would foresee these kind of risks also being absorbed by capital markets over time. However, it will start small. Investors will need time also as the reinsurers and insurers to get used to it, learn about it, get better models over time. And then I believe, yes, in the long run, there will be larger volumes absorbed by capital markets. I see cyber more suitable than other risks, like, for example, casualty liability risks, which is a totally different story. But the answer is yes, but it will start small, which is okay in my view, and grow over time.
Marvelous. Thank you very much for that. We are looking forward, all of us, I believe, to the growth of the ILS market for cyber and all other types. I'd like to thank, I'd ask you all to clap if you were here in person, and thank our panelists and participants for putting together this fantastically insightful presentation webinar about the securitization of cloud downtime risk. So since you're not here, please clap silently to yourself, and we know that you appreciate what they've done for us today. Thank you for taking the time, panelists. Thank you, attendees, for coming and participating with us today. I wish you all, it's a marvelous week. It's only Wednesday. Can't call the weekend yet. Thank you very much.